Revenue, the thing that separates Juicero from Airbnb. For those who don't remember, Juicero was a company started back in 2013 that was able to raise $120 million in venture capital. They created a Wi-Fi connected juicer that basically just squeezed bags, and they tried to retail it at $700. Needless to say, they didn't sell very many units and revenue never grew. They essentially went out of business once Bloomberg reported that they could squeeze the bag by hand to get the exact same result. Contrast that against Airbnb, who has been able to grow revenue at about 133% cumulative since IPO. But we've gotten in front of ourselves. First, let's talk about what is revenue. Revenue is the amount of money generated from the sale of goods and services. The easiest way to think about it is it's all of the money that comes into a business over a certain period of time. There are a couple different names that revenue goes by, such as the top line, gross income, somewhat incorrectly as total sales, or incorrectly income. Many investors will say that sales and revenue are the same thing, but there are some technical differences. Revenue represents the total amount of money coming into the business from the sale of goods and services, whereas total sales just reflects a unit volume. Here's a quick example. A services company like Accenture, who doesn't sell any physical goods, but maintains a staff of consultants for various projects, would report revenue as the amount of money coming in from their services. If they decided to invent something new, like a smartphone, then that would also be captured in their revenue. It's a minor detail, but is often misreported. Another thing that is often mixed up is the difference between revenue and profits. Let's use a lemonade stand as an example. So if I have a lemonade stand and I sell a cup of lemonade for $1, and in my first quarter I sell 1,000 glasses of lemonade, then my revenue will be $1,000. Now, obviously lemons aren't free to make my lemonade, and so my business will have expenses. The major difference between revenue and earnings, which we will cover in a later video, revenue minus expenses is equal to my earnings or profit. Okay, so now that we understand what revenue is, let's talk about how we can use it when evaluating our next investment decision. If revenue is going up, it can be a key indicator that the business is growing and has product market fit. And if it is going down, it can be a key indicator that the business is in trouble. So that's a quick summary on what revenue is and how is it useful. I had an entire section planned on revenue multiples and how to use them, but that's a little bit of an advanced topic and I'm running out of time. These videos are meant to be practice for me making YouTube videos for the first time and teaching people some of the well-founded ways to invest, but I'm quickly finding myself running out of time. And if I don't meet production pressures, the Flink Panda will be released on me. To quickly summarize, I think there are 3 takeaways from this video. The first is just simply understand the revenue action of a company that you're looking to invest in. By simply understanding the revenue action, you are already in front of most retail investors. The next level would be to understand the interplay between revenue and earnings. And then the third thing would be to understand some of the revenue multiples, which were not covered. If you found this video, or if you just enjoy watching me on the struggle bus as I tried to make YouTube videos, please make sure to hit that like and subscribe button. Thanks for watching.